Hey everybody, what's up? We are back once again with Best Buy. Now, Best Buy has been a little bit popular. I think it was almost a meme stock for a while, only because it was kind of like a sort of declining retail company. They've been making a bit of a comeback over the past year or so, seeing some pretty decent stock growth as well as some pretty decent performance. They are reporting earnings this week. They may have already. I may be a little late to the party on this, but I honestly don't remember what day they're reporting on. But anyway, Best Buy, let's get into it. We're going to look through their financials, we're going to look through their earnings, and then we're going to go into their actual stock chart and see how that is looking. So make sure to subscribe and let's get into it. Also, make sure to comment if you specifically want any companies. I try to get to as many as I possibly can. So if you comment what company you want reviewed, I will make sure to try to get to it. All right, everybody. So, getting into Best Buy, you could see two business segments. There's a lot that they have going on, but it is mostly consumer technology products and services. They have computer parts, they have appliances based around technology, things like that. But overall, it is a technology product retail company, essentially. So, getting right into it, cost of capital looks good at 8%. Target price is at 98, which they are at 89 at the moment. Looks good there. Long-term growth rate is at 3%. Now, again, I have here positive, depends on the industry, 10%, beating inflation. All of those things I kind of mix together and decide which one I want. Honestly, that long-term growth rate does not sound good. Usually, I always give the full credit there, but for a company like Best Buy, where they usually sell these like high margin products that are constantly innovating, things like that, you would think it would be higher than 3%. So that is a little surprising to me. But anyway, let's just get right into their income statement and we'll see what is going on there. So overall with sales, you can see they have been on the decline for a little bit now. It looks like peaking in 2022 based on this, which it looks like it is. They're actually essentially at the same level that they were at in 2018, almost 2015 right now. Now, again, another thing to note is that their net income is actually below where it was in 2015 right now. Or wait, 1,270 versus 1,240. Okay, not below, but very close. So 8 years have passed. I'm so sorry. Wait, 9 years have passed. Oh my God. And their net income is just barely higher. So that is something to consider when we're looking at this company. But overall, sales growth has been very bad. Obviously, you can also see their cost of goods sold decreasing right along with it. So don't get me wrong. They are clearly doing something about it, but for the most part, net income has not increased for a while. But operating income, again, we're just seeing a little bit of an actual increase over the past over the past year, which is a little surprising. You could also see net income has again increased over the past year, which is good. Now, one thing to note is these are preliminary results. This is for their past quarter, not the entire fiscal year for 2024. So this is a little bit more preliminary, but based on the preliminary, it looks like they are going to be outperforming their adjusted 2024 a little bit. Now, will that actually happen? We'll have to see when it's finalized, but overall, sales are declining, but net income and operating income are increasing. Now, is that enough to give full credit for? No, it is not. EPS, again, does not look fantastic. We're looking at a 5-year average of like maybe 7.88, right around there, and it's almost below 6 now. It probably will be below 6 soon. Overall, EPS does not look fantastic. For total shares, we want to see it declining, which, as you can see, it actually is a little bit of a surprise there, to be completely honest. We could see it's been declining for actually a very long time. They have always been reducing their total shares, which is excellent. So that is one thing that will definitely help the price of the company as they're going through this time where they're clearly trying to cut costs, reduce waste, shift business models from a brick and mortar store to more online sales, most likely. So overall, all that going on, it is pretty impressive that they're able to repurchase as much of their stock as they are. Now, will that help the entire company as a whole? Possibly, but we'll have to see longer term where they go from here. Overall, it looks like their cash has been declining for a while. You could see they actually don't have nearly as much debt as you would think. Now, I'm actually fairly surprised here. I was expecting them to have a ton of debt. Another thing to note, which I always forget about, their market cap is at 19 billion, as you can see right here, which is fairly respectable for a retail company, kind of in line with the industry. But overall, let's get back to the balance sheet. I just wanted to point that out, as they had 3.3 billion in debt, but they are almost a $20 billion company. So overall, short-term debt looks good. Cash, although cash has been declining, again, they've been repurchasing stock. I really don't care if it's not great. Assets have been declining very significantly. Not great there, but again, with the whole shifting business strategies, shifting the way you make your sales, going from most likely brick and mortar to online is going to require you to cut some of those assets. Definitely the property, plant, and equipment, which actually, shockingly, has been increasing. So most of the decreases, from what I could see, are from cash in total assets. So really, most of their asset declining is just them using their cash, from what I can tell. Now, as their assets are declining, I'm assuming their equity is as well, which it looks like it is. Total shareholders' equity is fairly staying the same. But again, overall, assets and liabilities basically just consistently declining over the past few years, which is a little surprising. Hopefully, we could see some across the board improvements very soon in the company. But let's get back to the ratings. Short term debt looks good. Long term debt has been, it looks like it's fairly consistent. A very slight increase over the past 4 years for this company is not bad. I'm going to give the 0.5 there because that's honestly way less than I was expecting. And then short term actually has come down, actually consistently came down over the past few years. So overall, half credit there. For retained earnings, we should see big positive here, 2.6 billion, which honestly is again less than you would kind of expect considering how long this company has been in business. And it has been declining over the past few years, but overall, no big deal there. Let's get into the cash flows. So starting off with their operating cash flow, we can see here it is positive. Funds from operations has been declining, obviously, as their sales go down. It looks like we have some working capital increases going from 200 to 800 million, and actually had a massive jump in working capital in 2021. But overall, funds from operation declining, not fantastic there. You could see the operating cash flow declining right along with it. So while it is positive, I'm going to do the half credit there because they really need to turn this around and make sure they're going to have to start bankrolling themselves with either selling stock or buying debt, which hopefully they won't have to do. Hopefully they can cut their costs before that happens, but that is just a risk in the future. So although it is very positive here and looks pretty good, the implications for the future could be pretty bad. But overall, investing cash flow looks fine. Financing cash flow, again, dividends, changing capital stock, fantastic stuff there. And then for free cash flow, you can see it has been declining, looking like there could be an increase towards the end of 2024 just based on the preliminary results, which is fairly good if that does happen. But if it doesn't, it could still signify the decline. But overall, the estimates are showing that they could begin increasing very shortly. Overall, I'm going to put another 0.5 there because we do not know yet. And the only solidified data we have is 3 straight years of decreases, which is not fantastic. Going to their use of cash, we can see, so they have been significantly and consistently repaying debt. Looks like they issued a lot here, but they repaid more, so that cancels out. Same with 2019. So overall, the debt repayment looks really good. Again, I highlighted earlier the stock repurchases. They have been massively and consistently repurchasing stock every single year for many, many years now. You can see they do issue equity every year as well, but that's most likely for things like employee compensation, things like that, new officers being hired, whatever. So overall, that is nothing crazy when you consider how many repurchases they are doing. So overall, that is really, really good for the company. Let's head into the ratios, see what's going on here. So first up, we are starting with the SG&A to sales, if this wants to load for me. And we can see the average is 17.3. They're at a little over 18 right now. It looks like they've been increasing for 2 years, which is not great for that. We want to see that decreasing. And again, it's increasing while sales are declining, which is just a double negative there, basically. I am comparing this to analog devices accidentally, which I just realized. Get rid of that. And we could see for the net margin, it is fairly significantly below the 5-year average of 3.6 at 2.86 right now. Now, again, if it was where sales were massively increasing and the net margin was declining, I could kind of understand that. But once again, they aren't. So that is not fantastic. And then the ROA and ROE are both below their 5-year average as well. So again, nothing to really speak about there. And debt to equity ratio should be fairly decent, which it is. You can see it's at 109, which again, over 100 is not great, but it's also not really the end of the world. So you can see that it used to be much lower. Then they started selling off their assets, losing their equity. And when that was happening, their long-term debt total equity increased. So overall, I'm going to do a 0.5 there only because I feel like this will be turning around fairly soon in the future as long as they continue their cost cutting and hopefully building up their net margin a little bit very soon. But so overall for Best Buy, we have a 44%, which is not the worst that we've seen. Certainly isn't as bad as some of the other companies we have towards the bottom here. But overall, 44 is decent. So now let's get into their earnings report and see what we have going on. And then after that, we will get into their actual stock chart. So let's just go right into the metrics recap. We'll see for their latest earnings, which was on the 26th of November. So overall, operating metrics, you could see they missed on the comps, missed on domestic. Domestic online had a slight increase, but honestly, nowhere near where it probably should be for the kind of online sales growth you would expect. International missed, which is not great. Domestic revenue missed. International revenue missed. Gross margin missed again, but increased from a year ago, which is something to definitely speak about. SG&A, unfortunately, also increased and missed estimates. Operating margin missed slightly just based on the year ago. They were in line with the estimates. And then merchandise inventories looks like increased slightly. Now, that would be good if it wasn't for sales declining. So they have more inventory, less sales, kind of a recipe for something, I don't want to say a disaster, but not great there. So overall for their earnings, that is not fantastic. But let's get into the chart. I'm still on CRNC here, but let's go to Best Buy and check out their chart. So you can see that earnings report. They've actually risen since then. Now, they did drop during the day a few percent, but overall nothing crazy. They did just have a price target increase, price target decrease, and their average targets is between 99 and 98. So overall, most analysts are expecting the price to appreciate slightly from here. But you can see their stock growth has been fairly consistent. Now, they are significantly below their high of right around 140 at the moment. But overall, if they can continue streamlining their business and hopefully cutting costs enough to where we see some increased sales growth, higher profits, things like that, they can definitely expect some all-time highs or at least consistent growth towards that over the next few years. But I believe that is it today for Best Buy. I appreciate if you watched. If you got this far, make sure to subscribe, make sure to comment, make sure to like. That is it for today. Hope you enjoyed. Hope you learned something. And I will see everybody in the next video.